everyday flow of money inside a company.
It's huge, isn't it?
Yeah, think about it. The goods, the services your company buys, all those invoices getting paid, it all seems so, routine. But what if there are hidden weak spots, little cracks where maybe significant financial fraud can actually happen?
That's a really important point because beneath that surface, that sort of day-to-day transactional flow, there are these, intricate pathways.
Yeah.
And they're often overlooked. A vulnerability that seems small can suddenly become a major leak, diverting serious funds.
Exactly. And that's really our mission today. We're going to do a deep dive into purchasing and billing schemes. We want to pull back the curtain on these sometimes ingenious, but often alarmingly simple ways these frauds happen. But maybe more importantly, we're going to reveal the strong controls and the clever detection methods organizations can use to protect themselves. Our goal here is to give you a clear, actionable understanding so you can spot the warning signs yourself.
Absolutely. And this deep dive, it draws from a really comprehensive guide. It's structured almost like a detailed checklist, offering incredibly practical insights. It's a resource originally put together by the Association of Certified Fraud Examiners, the ACFE. And for this session, it's been expertly reviewed and collaborated on by Yazan Abu-Ghush, who's a certified fraud examiner working with EasyPathUni. It's honestly a goldmine of practical knowledge.
Okay, great. So let's unpack this. Before we even talk about building the fortress, the defenses, we need to understand the enemy, right? What exactly are purchasing and billing schemes? What kind of tricks are we actually talking about here?
Well, what's really fascinating, I think, is how these schemes, even though they take different forms, they often exploit similar fundamental vulnerabilities. Usually it boils down to a lack of proper oversight or maybe a failure to really separate duties effectively. They prey on the opportunities hidden in routine operations.
Okay, so can you give us some real-world examples? What are the common ones people should really keep an eye out for?
Sure. One of the most, insidious ones is the shell company scheme. Imagine an employee, maybe someone in purchasing or accounts payable, who secretly sets up a completely fictitious company, a fake one they control.
Okay.
Then they create and submit fake invoices to their own employer from this, phantom company for goods or services that were never, ever provided.
Right.
The goal is incredibly simple. Just divert legitimate company funds straight into their own pockets. What makes it particularly nasty is how often these can go unnoticed for years because the fraudster might control multiple stages of the payment process, which makes it incredibly hard to spot unless you have really stringent internal checks.
Wow, yeah. That sounds like a silent killer for a company's finances.
Yeah.
What else should we be thinking about?
Another common one is the pay-in-return scheme. This one's quite clever because it often starts with what looks like a simple mistake. An employee might deliberately set up an overpayment to a legitimate vendor. Maybe it looks like an accident, like duplicating an invoice, or maybe it's more planned out. But the key is, when the vendor, being honest, returns that overpayment to the company.
Which is they usually would.
Exactly. The employee intercepts it, they pocket that refund. They essentially create a refund situation and then steal the money before it ever gets back into the company's accounts.
So they're basically creating money out of thin air, but it's the company's money.
Precisely. It comes directly from the company's legitimate cash flow.
That's tricky. Exploiting the vendor's honesty. And then I suppose there are the more straightforward methods.
Exactly. And that brings us to personal purchase schemes. This is probably the most direct. An employee might just fraudulently submit invoices for their own personal stuff to the company, hoping it gets paid.
Like their groceries.
Could be groceries, could be a new TV, could even be, funding parts of a vacation using company money. Or even more common these days, they just use a company credit card for personal items.
Right. The credit card bypasses some checks.
It can, and it's amazing how deceptively simple some of these sound, right? But without the right controls, they can easily go undetected for a long, long time, just steadily bleeding an organization dry.
Yeah, you can see why knowing these tactics is so critical. The simplicity is kind of what makes them so dangerous if the safeguards aren't there. So, okay, that leads us perfectly into building that secure system. When we talk about protecting a company from these kinds of schemes, where do we even start? What are the foundations?
Well, if you look at the big picture, a lot of these foundational controls, they really boil down to one critical principle: segregation of duties.
Segregation of duties. Heard that term a lot.
Right. It's all about preventing any single person from having too much control over a financial transaction, from start to finish. It's about building in checks and balances, making sure no one person can authorize something, record it, and then reconcile the payment all by themselves.
Like having multiple keys to a vault.
Exactly like that. No single person holds all the keys.
So how does that actually look in practice within departments, roles in a company?
It means, for instance, that your purchasing department needs to be completely independent from accounting, receiving, and shipping.
Okay.
You definitely don't want the same people ordering goods, then receiving them, and then also processing the payment for them. That's asking for trouble. And furthermore, the functions of actually doing the purchasing and receiving the goods, those should be entirely separate from processing the invoices, handling accounts payable, and managing the general ledger.
So clear lines between departments.
Clear lines. This separation forces collaboration and, importantly, independent verification. It just makes it much, much harder for one person to run a scam undetected.
Makes sense. And beyond just separating departments, what about the actual approval steps? Who needs to sign off on things?
Approvals are absolutely vital, and they need to be layered. For example, all purchase requisitions, those initial requests to buy something, must have clear management approval, period. Then you need a designated person who approves purchase orders over a certain dollar amount. And for really big purchases, you absolutely need multiple levels of approval. Maybe 2 or 3 people have to sign off.
So the bigger the spend, the more eyes on it.
Precisely. And any adjustments to accounts payable, like writing off a debit balance, which could be a way to hide a fraudulent transaction, that also needs management approval. And here's a really specific one for today's world. Dual approval is required whenever you set up a new vendor for electronic payment.
Ah, that's critical.
It is. It's a crucial gate. It stops a rogue employee from just creating a fake vendor, maybe their own shell company, and setting up payments directly to themselves electronically.
Okay, now here's where it gets really interesting, I think. Some protective measures might seem a bit odd or counterintuitive at first, but they're apparently very effective. What are some of those?
Yeah, this does raise an important question. Why on earth would a company require mandatory vacations for certain employees?
Right, it seems disruptive. You want your key people there.
You'd think so. But the reason employees in roles like purchasing and accounts payable should be required to take mandatory vacations is actually ingenious. When they're away, someone else has to step in and do their job.
Okay. I see where this is going.
Exactly. That forced break in their routine and having a fresh set of eyes look at their work often allows fraud to surface. If someone is running a scheme, their absence can make it really hard, maybe impossible to keep it going. And boom, it gets discovered. It's like a built-in surprise audit.
That makes total sense. It's a brilliant, kind of subtle way to enforce transparency. What other unexpected controls are out there?
Another effective one is rotating purchase authority among supervisors.
Instead of just one person always approving?
Right. If different supervisors are approving purchases over time, it makes it much harder for a fraudster to build a consistent pattern of abuse under just one person's watch. And alongside that, companies should closely monitor spending trends based on who is approving the invoices. If one supervisor's approved spending suddenly spikes or shows weird patterns compared to others, that's an immediate red flag that needs looking into.
So it's not just about catching fraud, it's deterring it too.
Absolutely. These are powerful deterrents. They help prevent fraud from even taking root in the first place.
Okay, so we've laid the groundwork. Strong controls, some clever deterrence methods. But fraud often hides in the details, right? Along every step of a transaction. So let's trace the money now. From the moment an order is placed right up until the payment goes out. Where are those critical checkpoints?
You're right. The devil is often in the details here. Preventing fraud in these processes needs a really meticulous approach at each step. It's about creating a solid paper trail, or these days, a digital trail, that can be easily audited and verified.
Okay, so starting right at the beginning, purchase orders and managing vendors, what are the absolute must-haves?
Okay, first, purchase orders.
Yeah.
They must specify clear descriptions of items, quantities, prices, delivery dates, all the key info. They should also be pre-numbered and accounted for sequentially. That way, you can make sure none go missing or get duplicated. It creates an unbroken chain.
Got it. Pre-numbered POs.
Second, maintaining a master vendor file is absolutely critical, and access to that file, strictly restricted. Any changes made to it, like updating banking details for electronic payments, must be flagged immediately for independent review.
Right, prevents unauthorized changes.
Exactly. And this file should also be periodically reviewed. Look for unusual vendors, strange addresses, and purge inactive ones. Keep it clean, only active, approved vendors. This helps stop those shell companies from creeping onto the list.
Okay, and what about pricing?
Good point. Competitive bids should be required for all significant purchases.
Yep.
This helps ensure you're getting fair pricing, but also that you're dealing with legitimate vendors, not just some favored one with maybe suspicious ties to an employee.
Okay, makes sense. So the order is placed, bids checked. What happens when the goods actually show up? And how do we handle the invoices correctly?
Right, so when the items arrive, the receiving department needs to prepare detailed receiving reports for everything they get and keep a log. Copies of these reports should go promptly to both accounting and purchasing.
Communication is key.
Absolutely. And crucially, vendor invoices, the receiving reports we just mentioned, and the original purchase orders, they must be matched before the payment liability is recorded and the payment is actually processed.
The three-way match.
That's it, the three-way match. It's a cornerstone of fraud prevention in this area. Simple concept, but incredibly powerful. It forces verification at every critical step. Did we order this? Did we receive it? Does the invoice match what we ordered and received? If yes, then pay. If no, investigate.
It closes so many loopholes.
It really does.
Yeah.
Without it, the door is just wide open for manipulation. Also, purchase orders should be recorded in a purchase register or voucher register, basically a detailed log of approved purchases before they go through cash disbursements, another layer of tracking. And it's important to make sure if you buy merchandise for direct delivery to a customer that it gets promptly billed to that customer and recorded correctly as both a receivable and a payable. Don't let things fall through the cracks.
Right, track everything.
And finally, keep good records of goods returned to vendors. Make sure they're accurately matched to vendor credit memos so the company actually gets its money back or its account credited properly.
That covers the traditional process really well. But what about company credit cards? They're everywhere now, and they seem like they could bypass some of these checks. What specific controls do we need there?
Yeah, company credit cards definitely bring their own risks because they're so easy to use, right?
Mm-hmm.
So organizations really need to establish clear spending limits for everyone who has a card, and also strictly limit the types of purchases allowed. Define it, communicate it.
No personal shopping sprees.
Ideally, no. And most importantly, you need original support receipts, invoices, and a clear explanation of the business purpose for every single transaction on a company card. No exceptions.
Accountability.
Total accountability. And finally, someone completely independent of the cardholder, someone who didn't make the purchase, needs to thoroughly review and reconcile each credit card statement every month, looking for irregularities.
That independent review sounds key.
It's absolutely key. It's often how personal use or unusual spending patterns get caught early before they become huge problems.
Okay, so we've built our defenses, we have controls, checks, balances. But what happens if something still slips through? Or maybe, how can an organization be more proactive? How do we become like fraud detectives ourselves?
That's a great way to put it. And it's not just about catching fraud after it happens. It's really about creating a culture of vigilance, where spotting these potential red flags is seen as normal, as a trigger for asking more questions, maybe digging a bit deeper.
Being proactive, not just reactive.
Exactly, proactive and curious.
Okay, so let's start with the paperwork trail again, vendors and invoices. What subtle signals should we be looking out for that might hint something's wrong?
Well, a periodic, really thorough review of that master vendor file is essential. Look for unusual vendors, strange addresses. Specifically, verify vendors who only list a P.O. box address.
Why P.O. boxes?
They can be legitimate, of course, but they're also sometimes used by shell companies to hide a real physical location. Also, check vendors where the address and the phone area code are from completely different geographical areas. That could be a red flag. Right. Also, investigate invoices that are missing basic info, like an invoice number, a proper vendor address, phone, fax, or maybe just vague descriptions of items. And definitely scrutinize invoices that show a different mailing address than the vendor's official address on file. That's a classic sign that a payment might be getting diverted somewhere else.
Okay. What about like physical signs on an invoice or maybe weird purchasing patterns?
You'd be surprised what physical paper can tell you sometimes. Look closely if invoices seem like they've been folded oddly, or maybe not folded at all if they should have been mailed. It might suggest they were printed internally by a fraudster, not sent by the vendor.
Interesting.
Also, check for any obvious signs of tampering, erasures, correction fluid, weird crossouts. Scrutinize invoices from suppliers nobody seems to know within the company or even in the general marketplace, especially if they don't seem to have any other customers.
A ghost vendor.
Could be. Examine orders for goods or services the organization doesn't normally buy, or for quantities that seem way out of line with normal operations. And pay attention to vendors who consistently charge way more than others for similar things. These patterns can definitely reveal hidden schemes.
Okay, so beyond the paperwork, what about people? Are there any behavioral red flags with employees themselves that might warrant a closer, but, careful look?
Absolutely. Now, this needs care. It's not about making accusations. But any really noticeable changes in an employee's lifestyle, sudden, flashy car, expensive trips that seem completely out of sync with their known salary, that warrants discreet observation, perhaps reviewing their work more closely.
Lifestyle changes.
Right. And it sounds basic, but sometimes just examining an employee's workstation or even their trash can turn up vendor invoices or letterhead that really shouldn't be there. It happens. On the data side, monitor if the same employee consistently approves payments to unknown vendors, or if they approve an unusually high number of payments going to individuals rather than established companies. That could directly point to a personal purchase scheme, or maybe payments to a shell company.
And can we use data analysis to spot broader trends?
Yes, trend analysis is a really powerful tool here. Organizations should absolutely use it. Look for abnormal vendor purchase levels suddenly spiking, or significant increases in the average unit price of certain goods for no clear reason, or maybe unexpected relationships or lack thereof between purchases and inventory levels.
Like if purchases are way up, but inventory isn't moving.
Exactly. Where are those goods going? These are all signals. They warrant deeper investigation. Not immediate accusations, let me stress that, but definitely a closer look to understand what's really going on.
Okay, so what does this all mean for you, the listener?
Well, this deep dive has really, I think, illuminated just how comprehensive the controls and detection methods need to be to truly protect an organization. Whether it's that strict segregation of duties we talked about, the multi-layered approvals, or just diligent monitoring of transactions and vendors, vigilance seems absolutely crucial.
It really is. Strong internal controls combined with a keen eye for these red flags we've discussed. That's what stands between an organization and potentially significant financial loss from these purchasing and billing schemes. It's about building a robust system, yes, but also knowing how to investigate, how to be curious when something just feels a bit off.
And it's worth remembering, what we've discussed today isn't just for massive corporations. These principles apply to any organization, really, even small businesses. And frankly, the insights can even translate to your own personal financial awareness, making you maybe more astute about potential risks in your own life.
That's a great point. Which leads to a final thought, perhaps. Considering how sophisticated these schemes can become, and factoring in the human element both in committing fraud and preventing it, how can organizations effectively balance that constant need for efficient operations with the ever-present requirement for meticulous oversight, especially in our increasingly digital and interconnected world? It's a complex challenge, isn't it? Something that really warrants ongoing thought and adaptation.